Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
All right, everybody, check it out. Shares of Peloton, man. Investors pedaling fast to snap them up. The stock soaring the most ever, although shares, I should point out, still down about 30% year to date. They're off about 97% from their all-time high. That was back in January of 2021. Let me just pull it up on the Bloomberg because the stock is right now up 36%. Let's get to it, though, because there's stuff going on. Bloomberg News Chief Technology Correspondent Mark Gurman is with us in the LA Bureau. Mark, we're usually talking Apple, and we might get there. Peloton, the latest results, earnings beat. It seems significant. This is a company that has continued to struggle since the pandemic. What's your take on kind of what we got, and does it mean that a corner has turned for Peloton?
Investors clearly are happy about the showcase of some better profitability, right? More free cash flow, more savings. But let's not forget, last quarter, their CEO resigned because clearly he didn't like the road he was seeing ahead of him. You had another 15% of jobs cut. That followed 3 or 4 rounds of layoffs in the prior 2 years. They've completely destroyed this business. Right? They've taken it from this hardware darling that made these popular bikes and treadmills and have re-architected it into an app business. I know investors are seeing the potential of profit here, and they saw that beat in this fourth quarter. But if you look ahead to the first quarter, you're going to see a dramatic revenue tanking on paid app subscriptions as well as their hardware purchases. So I'm not entirely sure why investors are so optimistic about this company. I personally think that a long-term future for Peloton is far-fetched. I think that the best approach for them would be to try to sell themselves to a Netflix or an Amazon and convince Netflix or Amazon for a few $1 billion to buy their very strong arsenal of content, right, and their application and that brand, and make that part of a Netflix subscription, an Amazon Prime subscription, to make that more valuable and get more people to sign up for their monthly services.
I mean, the whole company is worth less than what Apple paid for Beats, headphones that you don't even see anymore because Apple decided they don't even care about the brand. It's got to be the smallest company that I've ever heard you, Mark Gurman, talk about. They only grew revenue 1%, and as you said, it's expected to fall. The only reason they're getting fatter margins is because they're cutting costs. At the same time, it kind of reminds me of Apple in the sense that the market is just saturated for these very expensive devices, and they need to find other ways to get revenue. Do they have any other leads?
Yeah, I wouldn't be surprised if Peloton, as one last-ditch effort, winds down their hardware business completely, right? Tries to take a loss on that on their balance sheet and completely gets rid of it. There's nothing proprietary about their hardware, if I'm being completely honest, right? This is something that any company in America or China or wherever can probably replicate really quickly. It burns a hole in their pockets and their margins. They've destroyed this business. Barry McCarthy drove this business into the ground. He really had no choice after what John Foley did to it, thinking that this was going to become a $1 trillion company coming out of COVID and that people would never leave the house again. So I certainly think that the saving grace here is their content and their application. And I wouldn't be surprised in 2 to 3 years from now if Peloton hasn't sold itself, that it's an app-only business. And you could have a nice business as an application. We've seen so many companies be app-driven businesses. You have Uber, Netflix obviously is an app in many respects built around content. So the potential is there. But to your point, the only reason they're showing better profitability and cost savings is because they keep firing people and cutting costs. Now, back to my hardware point for a second. When their chief product officer, this was one of their few co-founders, left about a year and change ago, he was not replaced by a hardware person. He was replaced with someone who's an expert in software, in content, in server infrastructure. And I think that gives you some sort of indicator where this company is going, all in on that app. If they can turn that strong brand into a strong application, They have a future, but that's not a multi-billion-dollar public company.
Mark, where did they go wrong? Because they came out of the gate a hardware company, right? And there was a lot of fanfare, there was a lot of ads. I know we, as a media organization, did multiple stories and conversations. I know you were covering them. Where did they go wrong? Is it that they just thought too big, the spend? What was it?
Or was it just coming out of COVID? I mean, everybody was riding this bike in COVID.
But what I'm trying to understand is if COVID, I've got one. I canceled my membership just recently because I'm just,
It's a coat rack.
But I had it before COVID. Having said that, though, if COVID hadn't happened, would they have still had problems and issues, potentially?
They were this nice high-end brand, small company, prior to COVID. COVID hit, they exploded. Everyone wanted one, right? They were growing so quickly. They continued to hire. They made major investments. They rolled out new products. They doubled down on their content. But the worst thing they did was try to open this facility in Ohio to manufacture their own equipment in the United States. And they spent billions of dollars to do this, right? They're only now writing that all down. And they really, put themselves in a bad position. Fundamentally, they made a terrible bet that COVID would last for the foreseeable future, maybe forever. People, and I hate to be exaggerating here, but this is really what they thought. People weren't going to leave the house again. People weren't going to go to gyms again. They were going to only work out from home. And they didn't double down. They quadrupled down on that idea, spent too much money. Gyms started reopening. The world returned to some semblance of normalcy. And they were stuck with all this excess inventory that nobody was buying because people didn't need it. On top of that, they had crisis after crisis, including launching a treadmill that didn't have proper safety protections, that ended up killing a baby, hurting pets and hurting people. And then their bike had issues too, where people were falling off of the bike. So their hardware wasn't safe and their hardware wasn't very good. So it was just this multitude of issue after issue after issue on top of really bad bets that drove this company to a place where a new CEO had to come in, fire half the company, wind down much of the hardware business, and now they're left with an application that then ran into marketing issues, that then ran into cost issues. So they're not really in a great place right now, despite the new profitability they're showing.
Kind of sounds like next stop, the CEO has to be an expert in how to sell a company, right?
To be fair,
maybe
at the time, many of us thought nobody would leave the home again, right? And a lot of workers are still working from home.
You didn't think you'd go back to work?
No, I'd never spent a day at home.
Yeah.
I was in the office every day. But there were people who thought, this was a structural change. Not that we wouldn't literally leave the home, but that we would work from home, we would exercise from home, we would only watch movies at home. And a lot of that has happened.
Yeah, there's a balance.
Yes, but Matt, and you've seen so many other companies face this, right? You've seen other companies like the tech giants over-investing and having to pull back. But what Peloton should have done, right, was scale as needed. Mm-hmm. They refused to scale as needed. They went from 0 to 100 to prepare for demand that they were anticipating that never came. Yeah. The smarter thing would have been to follow the Dell and Apple model of supply chain and build to a necessary degree. Now, under this new leadership, they've done a lot of smart things to unwind the troubles of the prior management team.
Okay.
And they could have a pretty good app, but, and one last thing I will say on this, because it's
just
important.
Quick. Yeah.
There's no stronger brand in fitness than Peloton, so there is something still interesting there.
Right? It's a value. You say Peloton, people know. All right, interesting, and we figure there'll at least one more chapter to this, and he'll be covering it. Bloomberg News Chief Technology Correspondent Mark Gurman out there on the West Coast.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I got some numbers for you.
Okay.
Our Bloomberg News team put this out. That wellness, it's a big global business. It's about $5.6 trillion in revenue back in 2022. This is from the Global Wellness Institute. It's a big industry group. And they say research from the nonprofit organization says the industry has grown from $3.4 trillion in 2013. I'm throwing a lot of numbers. And by 2027, it's expected to grow an additional 57% to $8.5 trillion, about twice as large as Germany's gross domestic product.
Okay.
There'll be a test at the end of this.
Did you know that 76.1% of stats are made up?
Why do you say that?
I mean, how do you classify what people spend on wellness or not?
Well, people,
when I buy water, is that wellness
every
spend?
time you buy something, there's data collection, like there's stuff. Anyway, let's get to somebody who's got their own report on wellness and health and what consumers are actually thinking about their own state of health. The Kearney Consumer Institute has done some work. Katie Thomas is with us. She's lead at the Kearney Consumer Institute with us from Pittsburgh, Pennsylvania. I don't know if you have some comments on data, but let's go to your research. How are you?
I'm doing well, Carol. How are you? Matt already scooped, basically my whole brief by saying that is water wellness or not? Those are the exact kind of questions we were asking. So.
I played pickleball the last 2 nights, and it was $15 a session. Was that $30 spent on wellness this week?
Yes, right?
Yes, I would say so. Yeah, so I think you're asking the exact right question, which is, our motivation going into this was to understand a little bit more how actual people talk about health and wellness as opposed to how we tend to bucket it when we talk about it from sort of a consumer trend or spend perspective. When we talk to people about health, it's a lot more higher order than these like simple decisions that we're talking about here, whether it's pickleball or even GLP-1s or the sober curious movement. People have much headier ways of thinking about health, but they also feel like they know how to make healthy decisions. So that's an area where, as we look at these health and wellness trends and we keep kind of hammering home the communication of this is how to be healthier, most people don't actually need that messaging. They either are defining it for themselves or they already know how to do it.
Wait, so why did you do this? How do you guys take this and then either help your clients or find productive material and, help to make productive decisions out of it?
Yeah, so what we really do is, honestly, it's in response to the fact that everyone feels like they have to kind of jump at every little blip you see on the radar. So whether it's electrolyte powders or, gut health, or like, oh, I've got to move and make these small shifts to all these little ticky-tacky health and wellness trends. And what we found is if you have a better understanding of a consumer's overall lifestyle, that will be a lot more impactful. So I think a great recent example of this is McDonald's actually taking salads off the menu, right? Because they realize that when people go there, they're probably not looking for a salad. And there may just be other ways they define health from McDonald's. So it's not going all the way to a salad. Maybe it's grilled chicken tenders, things like that. So it's really starting to kind of translate some of the overall lifestyle considerations and where people make trade-offs and kind of couch things as health, like we said, as opposed to feeling like you have to overcorrect just because some small health and wellness, little trend is bubbling up.
I've been buying acai bowls lately.
My daughter loves acai bowls.
Although they're packed with sugar, so I'm not sure if it's much different than ice cream.
I've known you for such a long time when you weren't an acai bowl kind of guy.
Yes. Well, look, I'm leaning more into it because I'm getting older.
Is that why you've done it? A lot of it? What?
Yeah, of course. I want to live longer. I don't want to die of a heart attack and get diabetes. But you know what? I'm in a very large cohort, right? We're seeing, yeah. I was talking to Alan Patrikoff today, a famous VC investor.
Invests in longevity.
Yeah. His new company, Primetime, invests in trying to make life better for people who are older, and there are more people over 60 than there are under 18. So we're definitely, directionally, that's where we're headed, right, Katie?
Yeah, absolutely. And that's part of what we're seeing here is just like a preference for preventative health as opposed to some of the other, again, smaller things we've seen as a response to health lately. And then also, of course, factoring in mental health. And that's where some of this really starts to blur, is sometimes there's this inherent conflict with health of what's traditionally physically healthy as it relates to perhaps diet and exercise. And then what's sort of that self-care bucket, right? Like, having ice cream once a week or a glass of wine is sort of taking care of myself. It's good for my mental health. And so it's really, that's part of the journey, is figuring out for consumers and each brand's individual consumers, what are those trade-offs people are making? How are they defining health? What matters most to them? Like where they're going to kind of make a sacrifice. Like a lot of people still don't eat healthy things because simply they don't taste good. And then there's a lot of products like some of those electrolyte powders that's exactly why they're doing well, is because people don't like plain water. So it's really just like trying to bring all of those things together and strike the right balance to figure out what health really means to consumers.
I mean, I spend $6, at least $6 a week on a 12-pack of flavored seltzer water. Like the flavored seltzer water section at my grocery is now an entire aisle.
I know. It's like kind of crazy. I am just kind of blown away. I mean, and I feel like all we should do is be drinking water, to be quite honest.
I actually quit drinking, Katie, 2 years ago. I've been California sober for 2 years. What do you think about weed?
I mean, I think that's a great example of one way some consumers would claim that's not healthy and some would say it is healthy. I think sort of in a similar vein, Matt, we asked in our study what people think about GLP-1s versus like having more of a body positivity, self-acceptance message. 90% of people said self-acceptance was actually healthier body positivity messages as compared to GLP-1. So, I mean, I think you see all these trade-offs. Same goes with weed. Some people would say, hey, sober, not California sober. Others would say, do what you got to do that works for your lifestyle.
All right. So we're in an economy that some would say that there are a lot of, I think it's not even some, I think it's safe to say that there are a lot of Americans out there that are just struggling to kind of get by month to month. So having said that, I don't know if something came up in your survey about, when the economy's tough, it's harder to make those smarter, healthier decisions.
Yeah, absolutely. So some of what we saw, about 1 in 3 consumers said that finances are one of the things that stand in the way of them being healthier. And then 1 in 4 said access. So maybe not being able to, get to the right foods or get to a gym or what have you. So there certainly are trade-offs that happen there. But part of the other challenge that we're calling out with this brief is the issue with health washing, which is sort of similar to greenwashing, where everyone's throwing every claim on pack that they can. It's just ultimately confusing consumers when really we should be looking at, public health and public policy for more consistent messages on fresh fruits and vegetables and all of that, and just like being thoughtful about what the whole lifestyle looks like and where consumers can kind of make those trade-offs.
You got your undergrad in Ann Arbor, right? You got your MBA in Chicago. You're in Pittsburgh right now. You're like a solidly Midwest girl.
That's right.
Is it easier? Is it easier there because you're closer to the farms and natural food, or do you think on the coasts? I mean, is there a difference between like flyover country and New York and LA?
Just to clarify, those of us from Pittsburgh don't actually consider ourselves Midwestern. So I never grew up being Midwestern, but no, just to nitpick. But but I am. Let's be honest. No, I think, you do get a little bit of both. So it depends on what you're looking access to. The nice thing about, middle of the country is it does tend to be a little bit more affordable. But it really just kind of depends on, again, it goes back to what people define as healthy. So is healthy local versus organic? And there are arguments to be made in either way. If you're getting meat that's organic versus something that's maybe not organic, but like hasn't, the supply chain is a lot shorter. I think, once again, you get into those same sort of debates, and that's the whole challenge with health and wellness is you can kind of call anything health and wellness.
All right. Well, this was fun. California sober.
I liked it.
I know. People are Googling.
I'm a Midwestern boy as well. I will point out.
Yes.
Go Buckeyes.
I thought you were good. Oh no, I was going to say go Blue. I have a Jim Harbaugh bobblehead behind me. Sorry, Matt. We'll have to agree to disagree.
The bane of my existence. They're good lately,
I love it. Yeah. Katie Thomas, thanks so much. Be well. She's lead at the Kearney Consumer Institute, joining us there in Pittsburgh. Organic? Natural? What do you buy?
You know what? I will be honest. I was all about organic for years until I moved here and had kids and money got tight. I used to have so much disposable income as a single guy. And now that I'm married and I pay Westchester taxes and I'm paying college administration prices for preschool, I just buy whatever's cheapest.
I know it changes, right? When you have kids, everything's expensive.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, so from the Magic Kingdom to the platform formerly known as Twitter and its fearless leader. There's a few things on
and Silicon Valley at large, right?
Yeah.
I mean, there's so much going on out there, especially with Elon Musk's companies, not just Tesla and Twitter, but also Neuralink. Max Chafkin covers a lot of this stuff for us. But before we get to all of that, I want to throw him a curveball.
What? Ugh.
I'm ready.
I just ordered the Contrarian, so I think you'll see a bump in your revenue there. Max wrote the Contrarian, which is a story about Peter Thiel in Silicon Valley.
What? No.
And it's because he was on the Joe Rogan Experience. Did you listen to Peter Thiel on the Joe Rogan Experience?
You know, it's 3 hours. It's 3 hours long. I actually have not have not made it through the whole thing, and it's been you're sort of hinting at this, but the appearance has been memed. There's a lot of stumbling, a lot of sort of amusing back and forth between Rogan floating various I'd say Rogan interests and Thiel attempting kind of graciously to sidestep those.
It was amazing. First of all, you get a real read on how deep Rogan is into any right-wing conspiracy theory. I mean, he's all in on all of them. And then Peter Thiel seems to kind of debunk them one by one. On the other hand, Rogan asks Peter Thiel, like a couple, in 3 hours, 2 tough questions. And both times, Thiel is just absolutely frozen. He says, how come climate science isn't real science? And Thiel's like, and doesn't have a great answer for it. He also asks, why these left-wing philanthropy businesses are suspicious, and Thiel also freezes there. So I just thought it was just such a fascinating waste of 3 hours. I feel like I need to know more.
All right. Well, I want to know more from Max, because there is a story on the Bloomberg about those that are financing Twitter, or formerly known as Twitter, now known as X. So there is that story. Dana Hall and Rachel Metz putting it out. What do we need to know about that? And what's interesting for you?
Peter Thiel's not an investor in X.
It's not. No Peter Thiel, although plenty of friends of Elon Musk. Peter Thiel and Musk have a sort of fraught relationship. They're more like frenemies. This list, though, a lot of these names are going to be known to people who have followed either X or the whole saga. It's a lot of people who have close ties to Musk. So Larry Ellison, the software billionaire, Bill Ackman of Pershing Square Capital, a Saudi prince, Andreessen Horowitz, Sequoia venture capital firms, both of whom have sort of are tied closely with stuff that Musk is doing now. The biggest surprise is that Sean Combs, Diddy, was an investor in the buyout. So
it's interesting to me that, first of all, I love to say Prince Al Walid bin Talal's name. So I wanted to do that one time. It's super fun. And Bill Ackman is an investor as well. And he has been so heavy, such a heavy super user on Twitter. He even thought he could, I guess, raise and market a closed-end fund with all of his followers, but that was not so successful. Do you get any interesting insight from this list other than kind of the gossipy side of it?
I mean, I think, like I said, we knew a lot of these names because of other lawsuits and so on had shown some of these people came up in Elon Musk's text messages, back in 2022 and when he was discussing the buyout. I'd say the acquisition of X and Elon Musk's running it has always been a bit of a head scratcher. It's never totally made sense. Like, as a business, he overpaid for the company, which is part of the reason he tried to get out of it. Right. And for the investors, it's always been a head scratcher. I think really, like, a lot of these guys who are in this company are just like the banks that loaned him the money to do the buyout, are hoping for further connections to Elon Musk, to be involved in whatever the next deal is.
Well, maybe they should get a chip put into their brain. No easy segue. Only got about 45 seconds. I'm sorry, Max, because the little Rogan thing ate up some time. What do we need to know, though, about this second implantation?
So, yeah, Nueralink, that's Elon Musk's brain implant company, announced they'd put a chip in a second patient. Now, I should say the chip essentially allows the patients who are paralyzed, unable to like move a mouse, a cursor mouse or type before this. They're able to basically use a computer. It's exciting, but very, very, very early days. I mean, this is like the earliest kind of clinical trial. It's not even a clinical trial. It's like a preliminary investigation. So it's going to be many years before we see any of this commercially, at least from Elon Musk, although certainly good news for Musk and for his company Neuralink.
Always pretty cool stuff. Listen, Max, thank you so much. And thanks for putting up with Matt Miller.
I think, you know what? I'm so excited to read this book because you're going to learn more. You need to learn more about somebody who essentially is trying to buy himself into the White House.
We actually have had Max on to talk about the book. A lot.
I missed that episode.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, he's definitely dancing a little bit. We're getting closer to the closing bell, about 18 minutes away here. We've got stocks pretty much near their lows of the session. Charlie, of course, just breaking down the numbers. I do feel like, Matt, we're kind of all waiting for.
At one point, we were just 0.5% away from another record high, right? We're looking for 56.67. We got closer and closer to that on the S&P 500, and then we just fell away.
Yeah, I think we're kind of running out of steam, but maybe just waiting for Jay Powell tomorrow. Let's see what our Drive to the Close guest has to say about it all. Hamilton Lane is co-CEO. He is actually, I should say, Hamilton Lane co-CEO Erik Hirsch, and he joins us from Pennsylvania. Good to have you here with us, Erik. How are you? And just let's start big and broad. When you look at the market environment, what are the kind of things that you are focusing on? Is it Jay Powell tomorrow? Or is it something else?
So it's not Powell tomorrow. And again, happy to be here. So I think we know what we're going to hear tomorrow. I think we're going to clearly start to see rates coming down. But I think sort of from our perspective, sort of the concerns of recession or hard landing are sort of just grossly overstated right now. We're just not seeing the consumer spending in the areas that really matter and drive the economy. We're just not seeing those let up.
I mean, all of the sort of standout consumer issues and earnings reports have been down arrow stories, right? Like they're not booking enough at TripAdvisor or at Airbnb. We're not seeing growth to Disney's parks. Even, people at Walmart, if they're buying more stuff, but it's actually sort of people, wealthy people coming down from, higher end stores.
I've done that. I've traded down on brands like for things like, plastic bags or something. I'm like, I'm okay
with
you
buy plastic bags?
I know.
You're an evil person, Carol.
Oh, I knew you're
All right, come on, Carol, you can't be buying plastic bags.
Yeah, seriously. Now, on the other hand, if you look at the retail sales numbers, they're good. If you look at GDP numbers, they're good. So,
That's the issue, Matt. I think we got to be careful to not sort of conflate pieces here. Just because Disney's theme parks aren't growing is very different than saying Disney's theme parks aren't still pretty full. And so to me, when we talk about recession, hard landing, we need to see Disney theme parks coming way down. We need to see airline travel coming way down. We need to see restaurants empty. We need to see restaurant pricing way down. And that we're just not seeing. I think what we have is a real bifurcation in the consumer. There is no question that the bottom end of the consumer is getting hit hard. There is some social issues around that. There are some tragic issues around that, but they are truly struggling. The middle class and the upper class, however, are continuing to crank away. And again, for a lot of them, higher rates have actually been a real benefit to cash in the pocket.
So you guys have about $940 billion in assets under management and supervision. So I'm just curious, I know you focus a lot on the private markets. What are you doing with your client money? And by the way, I do buy a few Ziplocs, but I have all reusable bags. I don't use plastic bags in the supermarket or anything anymore before I get a lot of hate mail, although I might get some hate mail for Ziplocs. So having said that, what do you do with client money?
So we've been active. We are deploying. We have a lot of capital. Our clients have a lot of capital, and we are deploying a lot of capital. The private markets, I think, very different than kind of the public market dynamic, are continuing to expand. There are just more and more private companies getting created, and whether it's here in the US or outside the US, whereas on the public market side, the number of publicly traded companies around the globe, that is not a big growing group of companies. And so that is generally shrinking in most markets, as being public is challenging, it's expensive, it's time consuming. We know we are public. And so I think for a lot of investors, they want to get access to the sort of the broader growing part of the economy. And that tends to be the private side. Specifically, there's been a couple of areas that I think are attracting a lot of the capital in a good way. One, private credit. So regional banks really kind of hamstrung in this environment, out of the lending business. Private credit has sort of stepped in and filled that gap. Infrastructure, whether it's here in the US or in Europe, there is real need for major infrastructure spending. And so private infrastructure really is going to be the gap filler relative to what the governments are doing. So those are two interesting areas with interesting return characteristics.
I wonder what you think about the aging population and healthcare, because we've had investor after investor on my show, Bloomberg Open Interest, mornings from 9 to 11 on Bloomberg Television.
Shameless plug, but go ahead.
Who are saying, you know what, the demographics are so compelling, and pricing power is definitely there when it comes to saving your life. I mean, look how many people are willing to pay $1,000 a month for GLP-1s. Is that trade still not too crowded?
Well, we know, Matt, that acai bowls are not going to be the only solution for healthcare. So we're going to do more than just that. And I think that is an interesting trade. So healthcare, whether it's in the pharma space, whether it's in the service provider space. So again, aging population of boomers with a lot of capital. I don't expect that we're going to see all of them heading into kind of group-run facilities. There's going to be an awful lot of care at home, and that is going to create an incredible growth in private nursing. That's been a big area for the private markets, private healthcare providers, and sort of general home health. Those are other big areas for good capital absorption.
Hey, one thing I want to ask you, though, about private credit specifically, and listen, the last few years at Milken, and I've been there, it's like that's all anybody ever talks about. It's not the public markets, it's private credit. Having said that, you have increasingly more and more big firms that have gotten involved in private credit. You've got new market entrants. And so that extra competition has definitely pushed down some of those returns. What are you seeing on your private credit return investments?
So I would say a couple of things can be true. We can see more capital coming in. We can see more entrants coming in. We can see the big getting bigger. They are. That gap and that void that the banks have left, very large. And the amount of dry capital that's sort of sitting there in the private markets that needs to be deployed, and oh, by the way, leverage buyouts, they're going to largely get financed by private credit. They're not going to go into the bond market to do that. That game is largely moved away again from not only the regional banks, but sort of the big bracket banks are not the big providers anymore of kind of the lending capital inside of a leverage buyout. And so we're still seeing the returns being very resilient. You got to be careful. Again, not to say that every private credit manager is fantastic and no one's going to have any issues. That's not true. But again, this is kind of picking and choosing. But if I'm painting with a broad brush, I would say returns there look very good.
Very good is what? 16%, 20%, 10%?
I would say, again, we're talking about credit with credit protection. So I think what you're talking about is kind of a 9 to 13% rate of return. Mm-hmm. And again, on a relative basis to what you're sort of seeing in the public markets for credit risk with very low leverage ratios, I think a lot of investors are really happy to go take home a 10% rate of return.
All right, going to leave it on that note. Hey, Erik, thank you so much. Appreciate it. Erik Hirsch, he's the co-chief executive officer at Hamilton Lane, joining us there from Pennsylvania.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.